Two people, same age, same income, same $1,000 to invest every single month for the next 30 years. One follows a strategy that feels smart. Research, conviction, picking winning companies. The other follows a strategy that feels like giving up. Just buying the entire market and doing nothing. After 30 years, one of them has an extra $615,000 in their account. The other one has no idea how it got there. And the reason why reveals something about how stock markets actually work that almost no retail investor understands. Meet Alex, 30 years old, earns $75,000 a year, opens a brokerage account and decides to do what he believes is the intelligent thing. He spends 4 to 5 hours every week researching, reading earnings reports, watching financial news, following investment Twitter. He builds a portfolio of what he believes are the highest quality companies in the world. Apple, Microsoft, Nvidia, Tesla, a dozen names he's convinced will outperform the market. He treats it like a craft. He has a thesis for every position. He can defend every pick. His co-workers love hearing about his portfolio. He has stories. He has positions to brag about. He talks about his wins at dinner, at work, in the group chat. He feels like he's outsmarting the market. Now meet Sam. Same age, same income, same brokerage account. But Sam does something almost embarrassingly simple. He buys an S&P 500 index fund. Every single month. $1,000. No research. No thesis. No conviction. He literally owns every company in the top 500 U.S. corporations in proportion to their market weight. Then he walks away. No research updates. No positions to defend. No strategy to discuss. Just a number going up on a screen. Here's the question. After 30 years of consistent investing, who's actually richer? Because the answer isn't what most people think. And the gap between what feels like the right strategy and what actually works is hiding inside a single piece of research that almost no retail investor has ever heard of. For the first several years, Alex absolutely looks like he's making the obviously smarter choice. His Nvidia position is up 80%. His Apple is up 40%. He has wins to talk about. He brings these up constantly on his emotional scoreboard. The one made up of the positions he remembers and talks about, he is beating the market. But here's what Alex doesn't mention. There are also 2 stocks he sold for losses in year 2. There's the position he stopped buying after it dropped 30%. There's the one he's been holding for 18 months, waiting for it to break even, checking the price every day. He doesn't talk about those. Nobody at a barbecue wants to hear about your losses. On his actual brokerage statement, Sam is already quietly a few $1,000s ahead. By year 10, Alex, $171,000. Sam, $192,000. Gap, $21,000. It's small enough that Alex doesn't notice. He's not comparing his portfolio to Sam's. He's comparing it to last year's version of his own portfolio. And that comparison still looks great. His winners are bigger. His losers, the ones he no longer holds, don't appear on the statement at all. The gap isn't in the market. The gap is in what Alex remembers and what he forgets. Here's where it gets serious. In 2018, a finance professor ran the numbers on every common stock that has traded on a U.S. exchange since 1926. Close to 26,000 companies. He asked one question. How many beat 1-month treasury bills over their lifetime? Not the market. Not inflation. Just the safest government bond in existence. The answer broke everything retail investors believe about stock picking. 57% of all stocks underperformed treasury bills. The majority of individual stocks didn't just lose to the market. They lost to the safest investment alternative in the entire world. But it gets worse. When you add up all the dollar wealth created by the entire stock market from 1926 to today, the top 4% of companies created all of the net wealth above treasury bills. The other 96%? Collectively, they matched T-bills. They added 0. Just 86 individual stocks out of nearly 26,000 created half of all stock market wealth ever created. Read that again. 86 stocks. Half of all wealth. And this isn't just a U.S. thing. The same pattern holds in 55 out of 57 international equity markets. This is how stock markets actually work. A tiny number of extreme winners drag the entire average up. Everyone else hovers around mediocre. If you own the 4%, you do well. If you don't, you statistically would have been better off in government bonds. Sam owns every share of Apple, Microsoft, Amazon, Nvidia from the day they went public. No research required. No conviction required. The index does it automatically. Alex holds 12 to 15 stocks. Even if he picks better than random, and he probably does because he's holding blue chips that have already proven themselves, he still has to own the next generation of extreme winners and hold them for 30 years to capture the same return Sam captures automatically. That's just the first cost. There are 3 more. Cost number 1. Professional managers can't do it. Standard & Poor's runs an annual report called SPIVA. As of 2024, 65% of active large-cap fund managers underperformed the S&P 500 over 1 year. 84% underperformed over 10 years. 89.5% underperformed over 15 years. Over 20 years, there is not a single category, domestic, international, or fixed income, where the majority of active managers beat their benchmark. These are professionals, Bloomberg terminals, full-time research teams, MBAs from top universities. Whatever odds the professionals are getting, Alex's odds are worse. He's doing this on Saturday mornings. Cost number 2, taxes. Every time Alex rebalances, takes profits, sells a loser, or rotates into a new conviction, that's a taxable event. The average active retail portfolio turns over 15 to 30% per year. Sam's index fund turns over 2 to 4% per year, mostly handled tax efficiently through the ETF structure. Over 30 years, Alex pays $63,000 in federal taxes on realized gains. Sam paye $8,5 Difference, $54,500 that Sam keeps compounding. Every dollar Alex hands to the IRS is a dollar that can't compound for another 10, 15, 20 years. Cost number 3, behavioral mistakes. Studies of retail investor behavior across decades show what real people actually do with individual stocks. They sell winners too early to lock in gains. They hold losers too long, hoping to break even. They get emotionally attached to companies. They panic sell during market crashes. They buy high when something is trending. These mistakes cost the average retail stock picker roughly 2 to 4% per year compared to buy and hold. Over 30 years, that's enormous. Cost number 4, time. Alex spends approximately 7,800 hours over 30 years on research. That's the equivalent of nearly 4 years of full-time work on a strategy that statistically didn't beat the strategy of doing absolutely nothing. Think about that. 4 years of your life, for underperformance. Fast forward 30 years. Both Alex and Sam retire at age 60. Sam's index fund balance, approximately $1,785,000. Alex's individual stock portfolio, approximately $1,170,000. The gap, $615,000. That's the equivalent of a fully paid off house. A new car every few years for the rest of retirement. A completely different quality of life. And Alex never saw it coming, because his statement always said his portfolio was going up. His winning picks always confirmed his strategy was working. He never realized that the 3 small leaks, concentration risk, tax drag, and behavioral mistakes, were running simultaneously for 360 consecutive months. Each leak looked tiny in any given month. By month 360, they had compounded into $615,000. By year 15, Alex is $63,000 behind. By year 20, Alex is $150,000 behind. By year 30, Alex is $615,000 behind. And he has no single moment where he can point to and say, that's where I went wrong. He just lost to someone who did nothing. Now, every stock picker raises the same objection at this point. But what if Alex had just held Nvidia from 1999? What if he had held Apple from 1997? What if he had held Amazon? The math changes completely. It does. And it doesn't. Yes, if Alex had bought Nvidia in 1999, held it through every drawdown, and never sold a share, he'd retire wildly richer than Sam. But notice what that story requires. It requires Alex to have known in real time in 1999 that Nvidia specifically, not any of the dozen other obvious future of tech picks of that era, would become the company it became. It requires him to have held through 50% plus drawdowns multiple times without selling. And it requires him to be telling you this story with the benefit of full hindsight. Here's the counterexample nobody talks about. In March 2000, Cisco Systems briefly became the most valuable publicly traded company in the world. Cisco was the Nvidia of its era. The internet was being built on Cisco hardware. Every analyst on Wall Street was bullish. Cisco hit $80.06 on March 27, 2000. That high stood for 25 years. An investor who bought Cisco at its 2000 peak finally broke, even on price in December 2025. 25 years underwater on what was, at the time, the single most obvious future of technology pick in the entire market. Every "I bought Nvidia in 1999" story is told by someone who already knows Nvidia won. Nobody tells the story of the Ciscos that didn't make it, because telling that story doesn't get views. That's the trap. The 4% of stocks that drive market returns are obvious in retrospect and almost impossible to identify in advance. Sam captured every share of Nvidia, Apple, Amazon, Microsoft from day one of their public listings without needing to know which would become which. He owned the winners because he owned everything. He didn't need to be right. He just needed to not be wrong. That said, there are situations where individual stocks genuinely make sense. They're narrower than YouTube suggests, but they're real. Situation number 1, inside tax-advantaged accounts. Inside a Roth IRA or 401k. Most of what I just said about tax drag disappears. Realized gains aren't taxed inside these accounts. If you want to pick individual stocks, this is the right home for it. Not a taxable brokerage account. A Roth IRA. Picking individual stocks in a taxable account when you have Roth IRA space available is one of the most expensive mistakes a retail investor can make. Situation number 2. Genuine domain expertise. For the semiconductor engineer who reads chip papers for fun. For the pharmaceutical researcher who understands a specific drug pipeline. These people have what we call a circle of competence. Their picks within that circle have a better chance of being right than the average retail picker. But most retail investors don't have a circle of competence. They have a confidence. The difference matters. Situation number 3. Fund money allocation. Under 10% of your total portfolio. Pick names you find interesting. Learn how the market works from the inside. Just don't confuse the activity with your retirement strategy. The index core is doing the heavy lifting. The picks are there to keep you engaged, not to make you rich. Situation number 4. True long-term holding. For people who genuinely commit to 30 plus years on a small number of high conviction names without trading. This is rare in practice. Almost nobody holds anything for 30 years without selling. But if you can, there's a defensible version of concentrated investing. Here's what actually works for most people. Step 1. Build your core wealth in low-cost index funds during your accumulation years. An S&P 500 fund, or total market equivalent. This is where the math wins. Full stop. The index automatically captures the 4% of stocks that drive returns. It eliminates the tax drag of active trading. It removes the behavioral mistakes that come with caring about your positions. Step 2. If you want to pick individual stocks, hold them inside a Roth IRA. The tax drag disappears. You can scratch the itch without paying for it every April. Step 3. Keep any individual stock sleeve under 10% of your total portfolio. Treat it as entertainment or learning, not wealth building. The real trap isn't picking individual stocks. The trap is being told that picking the next Apple is the goal when capturing market returns is the actual goal. For most people, most of the time, building wealth with a 20-plus year horizon. The index doesn't just win. It wins by a margin that isn't close. And the reason why has nothing to do with whether you're smart. It has to do with how stock markets actually work. The choice between Alex's strategy and Sam's strategy isn't really about picking stocks. It's about understanding that 96% of what you can own is mediocre. And the only way to guarantee you own the 4% that matters is to own everything. That's not giving up. That's winning by default.